Okay, let's dive into this. Look, if you're wondering why the global economy is acting, well, kind of weird lately, why mortgage rates stubbornly refuse to drop, or why stock markets suddenly freak out even when central banks promise to cut rates, we really need to look right past those loud, sensational headlines. There is this massive, unseen force quietly operating in the background, and it's suddenly changing course.
Traditional media absolutely loves to point fingers at the usual suspects, right? The booming AI bubble, economic shifts over in China, or just the endless noise of US politics. But the real threat demanding our attention, it literally has nothing to do with those clickable, flashy topics. To understand what's actually going on, we have to look away from Washington and Silicon Valley. We need to look directly toward Tokyo and focus on what might honestly be the most boring asset on planet Earth, Japanese government bonds.
Seriously, for the past 30 years, Japan has essentially acted as the duct tape quietly holding the entire global financial system together. They've provided this constant, super reliable source of stability and capital. But here is the critical issue we're facing right now. After 3 decades, that financial duct tape, it's finally starting to peel.
So let's rewind a bit. 30 years ago, Japan's massive asset bubble burst. Real estate collapsed, equities crashed, and Japan entered what's known as its lost decades. With zero real growth and wages basically flatlining, the economy just hit a wall. It felt like someone simply hit pause on the whole country. Running totally out of options, the Bank of Japan had to take some drastic measures. They cut interest rates to zero, then actually pushed them below zero, which eventually led to this highly aggressive policy back in 2016.
And that policy was called yield curve control. Sounds a bit like a Marvel villain's master plan, doesn't it? But essentially, the central bank stepped in to explicitly cap long-term bond yields, totally regardless of what the open market actually wanted. Basically, the Japanese government superglued their interest rates right to the floor. But think about what that means for investors living there. With domestic bonds yielding virtually 0%, they suddenly faced a massive, massive problem.
Imagine for a second you're managing a huge Japanese pension fund. With domestic government bonds paying you exactly zilch, 0%, you've really only got 2 choices. Either accept literally no return, or you go shopping overseas. And naturally, this sparked a multi-decade global shopping spree. Japan became the largest foreign holder of U.S. treasuries, a massive buyer of mortgage-backed securities, and the world's largest net creditor. Effectively, Japan transformed into the world's ATM.
Let's walk through exactly how this ATM worked in practice. Let's imagine an investor. We'll call him Bob. So Bob borrows yen at near zero interest rates, converts all of it into US dollars, and then buys US treasuries that are yielding, say, around 4%. After factoring in some currency hedging costs, Bob just quietly pockets the spread. This brilliant, seemingly risk-free recipe became famously known as the yen carry trade.
And investors weren't just stopping at treasuries. When borrowing costs are practically zero, capital gets really, really hungry. This yen carry trade money absolutely flooded into mortgage-backed securities, tech stocks, real estate, emerging markets, you name it. Literally, if an asset had a pulse and yielded anything more than zero, Japanese capital bought it. It turned the country into an absolute fire hose of global liquidity.
Now, what's really interesting about this slide is just the sheer scale of it all. At its peak, banks estimated this massive trade to be worth trillions. Trillions. Global markets were essentially running on Japanese Wi-Fi. But here's the catch. This entire network, this massive trillion-dollar house of cards, relied entirely on one fundamental assumption, that Japanese bond yields would just stay glued near zero forever.
Well, forever ended in 2024. The Bank of Japan finally ended yield curve control and actually raised interest rates for the very first time in 17 years. And then they raised them again. The shockwave was immediate. Bam! The S&P 500 dropped 6%, and Japan's Nikkei 225 plummeted over 12% in a single day. The market was thoroughly spooked because, you guessed it, that foundational assumption was officially broken.
The rules of the entire game changed literally overnight because the math flipped. The old math, free money and zero borrowing costs, that was a total no-brainer. But under the new math, rising Japanese yields make borrowing in yen way more expensive, and currency hedging costs absolutely spike. Suddenly, the quote-unquote free money trade isn't so free anymore, and that 4% US Treasury isn't nearly as profitable as it used to be.
And it makes sense, right? When the math flips, the capital flows flip right along with it, triggering massive repatriation. Capital that flowed out of Japan for decades is suddenly making a massive U-turn and coming back home, simply because it's no longer profitable to keep it abroad. Let me be clear, This is one of the single biggest threats to global markets today. The cheapest, most reliable source of global liquidity is quickly evaporating.
To underline just how critical this whole shift is, legendary investor Ray Dalio points out that the bond market is the absolute backbone determining all asset returns. Think of bonds like the gravity holding asset prices in place. When the supply and demand dynamic breaks down here, it shakes the foundation of literally everything else.
And this clears up a massive misconception. We see the media hyper-analyzing every single move the Federal Reserve makes. But the Fed really only controls short-term, overnight rates. Long-term yields, like your 10, 20, and 30-year treasuries, those are dictated by open market supply and demand. If a massive, price-insensitive buyer like Japan stops buying, demand drops, and yields absolutely must rise to attract new buyers, totally regardless of what Jerome Powell says or does.
And this brilliantly illustrates exactly how the dominoes fall. When long-term yields stay elevated because foreign buyers are MIA, a brutal chain reaction begins. Analysts use these higher yields to value companies, which means the present value of future cash flows mathematically drops. This compresses overall stock valuations, forcing equities to trade at lower multiples, even if those companies are making great products and their corporate earnings are perfectly fine.
But honestly, this doesn't just impact Wall Street traders. It connects directly to your wallet. Elevated 10-year Treasury yields mean mortgage rates stubbornly refuse to fall, which keeps housing affordability completely strained. And as corporate credit tightens up, companies naturally slow their growth and their borrowing, which ultimately cools down the entire economic engine for all of us.
It really all comes back to a very fundamental principle. Liquidity is the oxygen in financial markets. For 30 years, the U.S. just breathed in the oxygen of the world's largest carry trade without even thinking about it. But when a major foreign buyer takes a step back, that liquidity tightens up, and the fundamental cost of money changes across every single asset class.
You rarely hear this kind of nuance on the evening news. We're constantly fed this oversimplified narrative that a single Fed rate cut will just automatically fix everything. But that comforting little story completely ignores a very uncomfortable truth. The United States runs trillion-dollar deficits every single year. We are issuing massive amounts of new debt just to keep the lights on. We constantly need new buyers.
Which leaves us with a really lingering thought to wrap up this explainer. For decades, we relied on a very specific set of mathematical conditions over in Tokyo to absorb our debt and keep our markets liquid. Well, that math has officially flipped. So, we really have to ask ourselves, what actually happens to the global economy if the largest foreign holder of U.S. Treasuries permanently steps back?